Hello guys, today we are going to break down the concepts that I did present in the previous slide on our YouTube channel. So please also remember to subscribe and hit the like button so that I can be able to upload more content for you guys, and also you can be notified once I upload a new video. So for today, I'll do a breakdown of those concepts, and I'll be posting another video in the course of this week of another slide with other concepts on liquidity. Please make sure to watch it so that once I come and do able to explain those concepts, you can be able to easily familiarize yourself with them. So today we'll start with market phases. The market phases, I know in the previous slide I did post about accumulation, markup, distribution, and markdown. Now forget about that. As a beginner, you have to start from a lower level. So I need you to concentrate on three phases, which is accumulation, manipulation, and distribution. So what is accumulation? Accumulation, in other terms, we also call it a ranging market, is whereby the market has not decided on which side it is going to take. So it will either buy or sell the market. That's why it is also called a ranging market. Example of accumulation or a ranging market is from this point. You see, market has not decided on which side it's going to take. The market has been ranging. It is indecisive. It is indecisive in other words. So this is accumulation phase. At this point, you see the candlestick are too small. The market is not making massive movements. It's just within this range. Then after this, you see manipulation. This is manipulation whereby the market gives a false signal or a false breakout. So many people see this signal and tend to buy. But now the market is not buying. It has not yet decided. This is what we call manipulation. It manipulates, taking out the orders of other people. It takes out the sell orders of sellers who had pressed who pressed the stop loss at this point, and then comes back to the range. Then now distribution. This is what we call distribution. This now is the distribution phase. Now after distribution, we go back. The market goes in a cycle. Distribution goes back to accumulation, manipulation, distributes. The cycle continues like that. Accumulation, manipulation, distribution. Now after seeing these structures in higher time frames such as 4 hours or 1 hour, you rush down to lower time frames such as 15 minutes or 5 minutes, and now wait for your entry. Now this red candlestick touch this area. Now if you are waiting for it at higher time frame, it's hard for you to notice this and put your entry at the exact point. But when you go down to lower time frame, you'll see how the market did trace back to this region before continuing with the distribution. That's why you get your precise entry and be able to put your straight stop loss to avoid being taken out of the market or blowing your account. So those are the three phases: accumulation, manipulation, and distribution. Another thing that we'll be checking today is about the higher highs, higher lows, lower highs, lower lows, equal highs, relative equal highs. Let me take this one out. So this is what we call higher high, higher low. Sorry, this is what we call the lower high, lower low, lower high, lower low, lower high, lower low at this point, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now, as you can see, the reason why it's called lower high and lower low is because for the lower high, the next lower high has not taken up the previous lower high. This high has not taken up this high. And the reason why we call it lower low is because this low has not taken up the previous low, and the market is going down. It's in a downtrend. So that's why the names of lower low, lower high come from. In the other words, in the opposite market, the uptrend market, we see the same thing. That the higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, then higher high. This high is taken out by this one, forming a new high. That's why it's called the higher high. This low formed a new low, but not as low as the previous one. So that's why it's called a higher low. It's low, but it's higher than the previous one. High and higher than the previous high. Higher high. Higher low. Low, but higher than the previous low. That's where the terms were derived. In other words, you can call them, if you look at the SMC charts, we'll be able to see other traders calling them swing highs and swing lows. But we also do have other swing highs in like this point, where we have the all-time swing highs or buy-side liquidity and all-time swing lows are sell-side liquidity. Like for instance, this one is a swing low. This one is a swing low. Why? Because the market will not break past this point. It did test this level several times, which is 1, 2, 3, and did not go past this point. So we can say this is a sell-side liquidity. Then buy-side liquidity, which is this point. The market has been testing this point several, but has not broken past it. And once the market takes up the buy-side liquidity, it goes for the next liquidity. If it does not break past this with a body, if it breaks with a wick and traces back, the body closes inside this liquidity, it shows that this market will be going for the next liquidity in the downward side. Yeah. Now we have identified several areas, which is in the uptrend market, the higher high, higher lows, swing high, swing lows. We have identified the buy side liquidity and sell side liquidity, lower lows, lower high. Now will be good to go to the break of structure and change of character. Now, what someone may ask, what is a break of structure? Break of structure. Break of structure. A break of structure is simply this one. The market taking out the previous low. So this is what we call a break of structure. And mostly it is valid when the market takes out the previous low with a body. This one is what we call a break of structure. But now, let me mark them first. It is mostly valid when the break of structure is taken out with a body. Yeah, as you can see, this is what we call break of structure, and the candlestick that took out this lower low did take it out with a body. Let me so that you may know the difference. The first break of structure, which took place in this, you see from this point to this point, the market had shown an upward trend. Yeah, but then came from a higher low, But now this high did not take out the previous high. Yeah, this high never took out this high. And then market came lower than this previous low. So this is what we call change of character. Change of character, whereby the market gave us a signal that it will be changing its character from what we had seen here. That the market was going to the upward side. As we had seen it here, most people are sure that this market is going to buy. But then, at this point, the market changed its course, changed its direction, gave us a higher low, but was unable to take out this high, gave us a lower low, took out this low, showing us that it's about to change its direction. Now, this is what we call change of character, or MSS, which is market structure shift. So once you see this, that the market was showing you that it's going to change, it's unable to take out this previous low. So you wait for your confirmation. Once the market gives you a change of character, it will trace back your point of interest, because the market will trace back to your point of interest. Then don't enter, wait for break of structure. So following this rule, the market gives you a change of character. Wait for it to retrace back. Do not enter. Wait for a change of wait for break of structure. First change of character, then retracement, then break of structure. Once the market gives you that break of structure, it's a clear sign now you are sure that this market will be selling if it's in a downward trend, or it will be buying if it's in an upward trend. So change of character, retrace, break of structure. Now your entry will be on the retracement. This point the market did retrace, and then that's where you have entry will be your sell entry or your buy entry if it's in an upward direction. Now after seeing the break of structure, you go to down time frames such as 15 minutes or 5 minutes. That's why you will be seeing the clear move and your entry point. After doing analysis in higher time frame, at lower time frames, that's where you'll be getting your sniper entries to the market with a good risk to reward ratio. So we have covered change of character, break of structure, all those stuff. Please remember to subscribe for the next video that I'll be posting about liquidity concepts, and also a follow-up video after that for explanation on the liquidity concept in a live chat. So for the previous video that I did post about this SMC ICT concept, once you are on the video, in the description you will see a link to the website where you'll be able to find the PowerPoint presentation. You can click the link, go to the website, read the concepts well, because for some of you the video may be too fast to be able to follow up and read the concept. You can go to the website, read the concepts well, able to understand them so that you can be well conversant with them. For the next video, I'll also be posting the link. Yeah, and the broker that I'm using, the Reef tends to obey these structures very much. That's why I'm using the Reef to explain these concepts. There is a link for the Reef for those who don't have the Reef accounts. You can click the link in my at the top in my channel or in the description of the video, so that you can be able to create your trading account and practice demo account, practice these concepts, identify them as we go on, because by the end of next week or next week but one, we'll be looking at entry models into the markets. How do you identify an entry point? How to enter and exit the market? Yeah. And how to put your risk to reward ratio. So let's continue with, you have seen change of character, breakout structure, market faces. Now we can go to premium and discount. So premium and discount is a term that is mostly used in ICT concepts. This shows the points where you're supposed to buy and sell. So you're supposed to sell at premium and buy at discount. Why? If we were to break this into simple terms, when you're going to a supermarket and you need to buy your stuff, you'll mostly buy things that have discount. You'll find tags with 50% offer, 20% offer. Those are the goods that you're interested in buying. The same applies to the market. You'll want to buy it when it's a discount, but sell when it's in premium so that you can get higher profit. So how do you identify these points, the premium and the discount? You simply take your Fibonacci retracement tool. From your Fibonacci retracement tool, you put it at your highest point of the market to your lowest point. So let me adjust. This was the highest point and this was the lowest point. So you do not want to sell when it's in discount. Let me put some adjustments so that you can see the premium and discount very well. So the 50%, from 50% to 1 or 100%, this is what we call the premium. From 50% to 0, this is what we call the discount. But then it depends with how you placed your Fibonacci tool. For someone else, may place the 1% pin down here and the 0 pin on top. So always remember that on top is premium, down is discount. You want to buy when the market is here and sell when the market is at this point. Now from our points, from this point, this was the lowest point, to this point, we want to sell. Do not trade opposite direction with your market, with what the market has shown you. The market structure has shown you is the selling market. So you don't want to buy. You are looking for a sell. So you wait for the market to come at your premium level for you to sell. So your entries will be from 50% to 1 at this level. This is where your entries will be. This is where your entries will be, these points. So as you can see from your side, remember we say that trading, you trade what you see. Don't trade what you know. Trade what you see if you want to be profitable. So entry at this point, you see this was a good sell. Market came back to premium again. Then someone did the entry or enter this point at the premium. Don't sell at this point. Wait for the market to come on the premium. This is what now we call the premium and discounts using Fibonacci retracement. We shall break down how to use the Fibonacci retracement tool to have precise entry points in our other videos. Apart from premium and discounts, Um, you have seen the swing highs, swing lows, which are the same as higher highs, higher lows. You've seen the all day swing highs, all day swing lows. Next, we'll be looking at liquidity at our next videos. We'll be also looking at the previous day liquidity, previous week, previous month, or daily liquidity. We also those terms are mostly available in liquidity, so I would like to record a detailed video on how to identify liquidity zones, how to trade liquidity. So for today, I was just showing it for in a red market so that you can be able to identify them easily. So by now, I think you know how to identify accumulation, manipulation, and distribution. You know how to identify higher highs, higher lows, lower highs, lower lows, equal highs and equal lows. You know how to identify break of structure, change of character or market structure shifts, premium and discount. Now, let me see where we can identify equal highs and equal lows. Start with relatively equal highs and relatively equal lows. So for instance, these are relatively equal lows, where the market tends to form lows that are almost at the same level. So this is a relatively equal low. When the market forms a relatively equal low, it will reject from that level. So from this point, you see the market did go upwards. When you see relatively equal lows, the market will always tend to reject before coming down to take out these points. But they are very hard to identify because the markets are very volatile. You identify one and it will either give you a false signal or give you a net entry. So it's good to know them, but you will rarely use them in your analysis. This one is a relatively low. We have relatively equal high, relatively equal high, apart from the true against so yeah. Mostly you identify them at all-time highs or a strong buy side liquidity. When that's where you find relatively equal lows or equal lows, and on sell-side liquidity, that's where you find relatively equal highs. Remember, sell-side liquidity is in the upwards, buy-side liquidity is always because to buy, that's where the stop losses of many retail traders are. So they tend to move the liquidity to that point, which will lead to liquidity sweep. Then the market will go for the sales and liquidities which are on the top, take out the liquidity. Yeah, that's how the market behaves. So taking out the liquidity, it will try to retrace back before giving an impulsive move. So for those terms, we'll be looking at an order block and the impulsive value gaps and impulsive moves. So good order block may be, I would say, normally found after the break of structure. For instance, and make the very abstract and see how it comes. So from this point, you see the outlook is from yeah, market can be different. Then we will build the structure. Market is the stability, structure and look at structure. So before this type of structure, there is another block here, a dodgy W. This is a very strong point. This is a very strong point. We have this other block. We have that other block. And the other block is followed by a fair value gap. That other block is followed very closely by a fair value gap. So this is a very strong point. That's a very strong point where that's why you see the market has been respecting this order block. It did retrace to this point, took out the liquidity on the wick of this order block, then went to the downward side. So once you go to 15 minutes, so you'll be able to identify a good entry. It came back to retrace to the order block and then proceeded with the downward movement up to this point. This was a strong rejection point, and you see this order block did hold for quite some time. It gave an inducement at this point. This is what we call inducement. We'll be explaining them at liquidity concepts. Yeah. And once this order block was taken out, there was another order block that was formed at this point. This order block, we'll be looking at order blocks in detail. Is this order block that was respected at this point. It did hold up, and the market got rejected from this order block up to this point before breaking. But before breaking the order block, we see the market was a bit, the candlesticks were too small at this point. It was about to form an accumulation phase before the impulsive move upwards. So we'll do a video on order blocks and how to identify good order blocks. So that's all I can say today. I was just trying to break down these concepts into easier terms, simpler terms that everyone can understand. More concepts will be coming up, more explanation videos will be coming up. Yeah, there will be a series of videos about ICT and SMC. So make sure to subscribe, and like, and comment on points that you like me to touch on, so that as I do cover the ICT and SMC concepts and explanation, yeah, I can also be able to cover the points that you feel have been left out or have not clearly explained them for you to be able to understand them well. So let's continue learning, continue trading. Yeah, invest on learning first before going live on trading. I myself have been learning from YouTube for quite some time, but you don't really get the step-by-step guide. You don't get to know how to do top-down analysis, how to have precise entry points, how to do your risk management very well, because people will be posting different short videos or detailed videos, but they don't really tell you the exact point that you need for you to be a profitable trader. So invest on learning. At the end of this series, I will now bring a strategy, a breakdown strategy, step by step on how you can do analysis and have a good entry at the market. Thank you for listening to me. Let's meet up in our next video. Thank you.